All right, let's talk about something that, let's be honest, can feel super intimidating: investing. You know that feeling? Like finance is some kind of exclusive club and you don't have the secret password? Well, if that's you, you're in exactly the right place. We're going to demystify this whole thing together. So let's just jump right in with a question that might hit a little close to home. You work hard, you're responsible, you put money away in a savings account where you think it's safe, but is it? Is that cash you've saved secretly getting weaker day by day? The short and kind of scary answer is yes. And the culprit has a name: inflation. I mean, think about it. When the price of everything, from your coffee to your gas, goes up, each dollar you have buys a little bit less. With inflation around, say, 5%, that money you have just sitting there could lose half of what it can buy in less than 15 years. It's like a silent leak in your financial boat. So first up, we're going to dig into exactly why that safe bank account is actually a bit of a trap. And then we'll talk about the single most powerful tool you have to fight back and actually grow your money. Okay, check this out. This slide tells you pretty much everything you need to know. We've got Jack, Jill, and Joey. They all invest the exact same amount, just $200 a month. But look at these numbers. Jack starts at 25 and boom, ends up with over $500,000. Jill waits just 10 years to start and gets less than half of that. And Joey, who starts at 45, well, he barely breaks 100 grand. That right there, that is the incredible magic of compound interest. It's where your money starts making its own money. It really is the engine of wealth, and the only fuel it needs is time. Now, if you're looking at that chart and thinking, yeah, but I'm just not a math person, just stop right there. Seriously, one of the biggest myths we need to bust is that you have to be some kind of math genius to invest. You don't. If you passed 5th grade math and know how to use a calculator and the internet, you have all the skills you need, period. So you're probably thinking, if it's not that complicated, why does it feel so impossible sometimes? Well, there's a fantastic word for this: Gongorismo. It's named after this poet from way back in the 17th century who wrote stuff that was deliberately confusing. Sound familiar? The financial world does this all the time. They use all this crazy jargon, not because the ideas are actually that hard, but because it creates this wall. It makes you feel like you're not smart enough and that you have to pay them to understand it. Well, forget that. We're about to take a sledgehammer to that wall of Gongorism. In this next part, we're going to look at the two super simple tools that are the building blocks for pretty much the entire world of investing. Okay, first up, stocks. You might also hear them called shares. The idea is actually beautiful in its simplicity. When you buy a stock, you are buying a tiny, tiny slice of a company. You become a part owner. And if that company does well, your little slice of the pie gets more valuable. Simple as that. And this isn't some newfangled idea either. This concept of shared ownership is literally what funded the age of global exploration. It built the factories of the Industrial Revolution. It was a way for regular people to pool their money and invest in these massive world-changing projects without having to, sail a ship across the ocean themselves. All right, tool number 2 in our kit: bonds. Now, if a stock is about ownership, a bond is just a loan. That's it. You're lending money to a company or even the government. In return, they promise to pay you back the full amount after a certain time, plus regular interest payments along the way. You can think of bonds as the much safer, more predictable cousin of stocks. So let's just break that down real quick. Stocks mean ownership, bonds mean a loan. Stocks have the potential for much higher returns, but that comes with higher risk. They're what you want for growth over the long term. Bonds, on the other hand, have lower returns, but they're also way less risky. They're great for stability and for creating a steady income. It all comes down to that classic trade-off: risk versus reward. Okay, let's address the elephant in the room. I can hear you thinking it. Higher risk, so I could lose it all? Isn't this whole thing just a glorified trip to Vegas? And you know what? That's the number one fear every single beginner has. And it's a totally fair question. And that brings us perfectly to our next section: taming the risk dragon. Because look, the goal isn't to pretend that risk doesn't exist. It absolutely does. The key is to understand it and use a simple, powerful strategy to keep it in check. And just to show you how real this risk is, here's an amazing story. We're talking about Sir Isaac Newton, the guy who discovered gravity, one of the smartest people who ever lived. Well, he lost an absolute fortune in his stock market bubble way back in 1720. How? Because markets aren't always logical. Sometimes they're driven by pure emotion, what we call market sentiment, just raw fear and greed. And that can sweep anyone up, even a genius. So How on earth do you protect yourself from that? With this. This is your shield. It's a strategy called diversification. It's really just a fancy way of saying, don't put all your eggs in one basket. You can see here, you spread your money out across lots of different things. Stocks from different countries, some bonds, maybe a little cash. That way, if one part of your portfolio has a bad year, the others can help balance it out. It just smooths out the ride. Okay, so we've busted the myths. We know what stocks and bonds are. We even have a shield to tame the risk dragon. Now for the really important part. Section 4, the simple, actionable steps you can take to actually start doing this. Forget all the noise and complexity. It really boils down to this simple 4-step launchpad. Number 1, figure out your why. What are you investing for? Retirement? A down payment on a house? Get clear on your goals. 2, do a little homework. You've got the entire internet at your fingertips. There's so much great free information out there. 3, pick your platform. These days, modern online brokers make it incredibly easy to get started. And finally, number 4, and this is crucial, start small and think long-term. You don't need a pile of cash to begin. You can invest small amounts regularly, which is a great strategy called cost averaging. And that really brings us to the final thought here. The financial world is an expert at throwing that Gongorismo at you, making everything seem way more complicated than it is. But when you strip all that away, what are you left with? Just a few simple, powerful ideas. And a choice. So here's the question I want to leave you with. What if the hardest part, and the most important part, of this entire journey is just making the decision to begin?